Welcome to another video by REITspro.com. This is Gaurav Jain, and today our main topic is REITs are falling. Why? And what can you do about it? So the American markets have already had REITs going down, Singapore markets also, and Indian markets, you've all seen how REITs have fallen over the period. In fact, it's in a turmoil, and REIT investors are a worried lot today. So can you tell me if it will fall further? That's probably what you'll ask me here, but only if I could accurately predict the markets. It'll be very, very nice, but the nature of the markets is such that we would always have guesstimates. Now, REITs prices, in my understanding, would continue to be under pressure. Firstly, if the fear of interest rates going up unexpectedly more is there. So if you expect the interest rates to keep rising more, and they'll rise more than what you've discounted for, that could be a problem. The second thing is the economy. How do you view the economy, the Indian economy? Would it be under a recession or not? So the analysis here is to adjust our tuning with the markets, and you'll always be worried about this main question here, that does it make sense for me to buy for returns, because REITs give you high returns. Now when the capital is eroding, would it make sense for me to buy it? That is a pertinent question, and something that you'll always struggle with in such a market. So you would really do well to know your investment instrument for peace of mind and how you would plan out your actions. And there are three main things you should probably look at there. What are your limitations? For example, taxation. These are tax efficient instruments. What is your portfolio size and how much of it is being allocated to REITs? And third, what are your other priorities from investing in REITs as well as in other instruments? So you can get to know REITs better by staying in touch by all these ways, WhatsApp, Telegram, or sign up for regular newsletters. Or you could go to the trainings page and see what we offer for trainings, one-to-one, and so on. So the interest rates and REITs have a relation as such, which goes like this. From here, if you see inflation can cause interest rates to rise, then more incomes from the same asset are needed now. Why? Because you had calculate a certain percentage that, okay, I'll invest this in REITs and I would get this percentage, and now since inflation has risen and interest rates have risen, comparatively you feel that you need more from the same REIT assets, and then that results in a fall in REIT prices because the demand becomes lesser. So it's a question of demand being lesser than the supply here in this case. And this is where the inverse relationship of cash flows and fixed income instrument comes into play. Although I will outline later how this should really not be taken as such. But if you consider an initial scenario where a bond is valued at 100 rupees and the coupon there is 7%, so income there would be on would be 7 rupees per annum. Now the inverse relationship can again make this happen. Now if in a new scenario, rise in interest rates happens by 1 percentage point. Now what happens is that income required now is 8% or rupees 8 on whatever you invest. So you will naturally not invest 100 rupees. You will not pay 100 for a fixed yearly payment of 7 rupees, right? What would you pay? You would pay only lesser to get 8%. So you would really likely to pay 87.5 rupees to get 7 rupees, which is actually fixed. This is a coupon rate is fixed. So 87.5 is what you will pay to get 7 rupees, because that translates into 8% returns. And why it's happening probably is because of this. So the interest rates are up, therefore, because the inflation is up. So the interest rates are up because inflation is up, and the capital that flows into fixed asset, its nature changes. Why? Because other fixed income securities start looking good. So now you say, okay, REITs give me so much percent. In fact, that corporate bond is giving me a little more than this. Or even if it's the same, then I find it safer. So what happens is that the REIT prices come down because there is less demand for it. So money flows, the capital flows into other fixed income assets. However, if you really look at it, these are not really, REITs are not really fixed income instruments. In fact, REITs with affair with interest rates is not that simple as debt instruments, because the future scenario is dependent on several more factors. In case of REITs, it's not just a simple interest, the percentage of interest kind of an equation that you have in a corporate bond. So REITs and inflation, there are other factors, and that I have detailed earlier on another earlier video on REITs and inflation, and the impact on rents, valuation and debt. All that has been explained at pretty much in length there. However, to outline again, the acceptance of interest rates and changes in values is what is important here. So when inflation happens and interest rates rise up, obviously because of inflation, now one more thing happens is that the landlords can demand more rents. Now it depends on the business environment and how the attitude of the tenants, whether they would let that be passed on. But mostly what happens is that it passes on. The cash flows would in all probability increase, and so would the underlying value of property. So these two things would naturally, that is something that should be a natural thing that would happen with inflation, given that the economy is fine. So as you see today also, the NAVs versus market price, there is a lot of disconnect. The Brookfield valuation happens to be on 30th September 337 rupees approx, and the market price is under 300 rupees in mid-November. Similarly, Embassy REIT valuation is around 400 rupees on 30th September, whereas the market price is under 340 rupees mid-November. So what are the future prospects is probably what one has to take a call on here. So because that disconnect, you need to see what the disconnect is there in one way of looking at it. And the recession probability and the forecast is outlined in this picture here. So India has, according to a lot of economists, there is a very small probability of recession, in fact nil. So no housing. And the second factor is that we also must consider is that there is no housing REIT in India. There are only commercial REITs. So what's your attitude and outlook on the recession slowdown? And REITs have in fact done traditionally very well in eras of high inflation, and this is highlighted by this chart here, where the dark blue one talks about the dividend growth and the consumer price index. That's the chart here. So out of these 20 years, it's done well in almost all the years here, the dark blue line. Similarly, when we compare to equities, now these are the charts here. So the charts here would give probably the REITs are giving sometimes more than equities also in case of moderate inflation, and high inflation they give a little more. And apart from that, there of course the dark blue line is about price returns, which come down, but the yields go up. I mean the yields are nice compared to S&P data. So REITs continue to decline, but analysts are positive. Probably that is the whole reason, because that's been the past trend. And the current fall, you would always have this question: does it make sense for returns, to take returns when capital is eroding? So the macro factors like your attitude to investing in REITs, are you a trader? Are you a value investor? Are you taking in for diversification? All these would matter when you ask yourself whether I should wait or grab this opportunity. So I have told you my broad understanding of this, and I also ponder about several things in this case. And there's an important message for viewers, and there are 3 questions I'd like to ask my viewers, and I would request the audience to think over it, and we can interact on that as well, because there are 3 questions which emanate from one single thought here. And that thought is, what is your assessment of this fall? Let's interact and discuss. You can join our WhatsApp group. The link is given in the description below. So the 3 questions that I feel that we should ponder over is are the REITs falling due to bulk deals and sponsor exits? So that's the first question. But if this is true, then why would all Indian REITs fall, and why is it a global phenomenon? That's one. So there have to be macro factors, as I understand, but I would like you all to discuss on this also. The second, why are InvITs less impacted by the increase in inflation and consequent interest rates? Do InvITs cash flows don't they look more consistent and predictable as inferred from valuation reports? The third question I have is, how did equity and dividend stocks behave in the same period? Do you consider that inflation does not impact them? They are protected against high interest rates. So then why not REITs? And aren't these meant to be a little like equity also in this matter, though with a time lag? So the good dividends and price rebound is probably highlighted in two cases I've picked out here of the PFC and the Coal India Limited stocks. Do let me know your thoughts. Is it more about market sentiments? Is this good reasoning of investors? What do you think? Join the group and as given in the description below. Thank you so much. If you like, please subscribe and share this with others as well. Thank you so much for watching the video. Thank you.